One of the most successful entrepreneurs in America over the past 50 years is going public with his fourth and final prediction about a scenario he calls America's nightmare winter. You've probably never heard of Bill Bonner, but in addition to owning an interest in businesses all over the globe, he also owns more than 100,000 acres with massive properties in South America, Central America, the US, plus 3 large properties in Europe. Bonner says we're about to enter a very strange period in America, which could result in the most difficult times we've seen in many, many years. Bonner has made 3 similar predictions in his 50-plus year career, and each one proved to be exactly right, although he was mocked each and every time. This is why I strongly encourage you to read about Bonner's fourth and final prediction totally free today. It's all spelled out in a free report we've put together about America's nightmare winter scenario. Get the facts for yourself. Go to americasnightmarewinter.com to get your free copy of this report. Even if he's only partially right, it will dramatically affect you and your money. So again, go to americasnightmarewinter.com for this free report. Hi, this is Daniela Cambone, and welcome back to the Daniela Cambone Show here on Stansberry Research. Back with us today is best-selling author and investigative journalist Nomi Prins. She also has a new book coming out, Permanent Distortion, October 11th, but available for pre-order now. She joins me now. Nomi, always good to see you. Welcome back to the show.
Thank you so much. It is always fantastic to be here and talk to your audiences.
Absolutely, and we have a lot of ground to cover with you. You know we're going to talk the Fed, but first, I want to talk about a recent headline that came out this week. The National Association of Home Builders says the U.S. is in a housing recession as sentiment turns negative, tying this into one of your recent tweets where you say, and this is citing a Bloomberg article, the Fed has created major distortions in a market where many Americans have most of their wealth, and the impact may be felt for decades. Let's talk about this. How much of a dent will it make in the housing market?
Well, first of all, this is the 8th straight month of negative sentiment in the housing market.
Correct.
And that sort of coincided with expectations the Fed was going to raise rates through effectively all the raises in rates that they've done this year so far. And what's happening and why this distorts the real economy from more the leveraged assets markets and what happened before the Fed started raising rates is that real people take out real mortgages and pay real monthly components of their incomes that are not keeping up with inflation to pay those mortgages. And so when rates go higher, especially when they go higher so quickly, it inhibits the average home buyer from purchasing a home. And then that knocks on to construction because from a construction perspective, any projects that were ongoing throughout this period all of a sudden potentially can pause. And what that will create later is ultimately another squeeze in the housing market. But for now, it creates kind of this negative combination of a dearth of affordable housing and high rates, which inhibit people from being able to afford mortgages. And I'm talking about real people in the real economy, not your institutional buyers. And that is a problem because the Fed, when it looked at inflation as something it proposed to be able to control after it got over the fact that it was transitory, has really hurt the housing market the most. It's done it in this housing numbers. It's also done because rates have gone so high that rents have gone up substantially because people can't buy those homes. So now there's this major gap growing between the high cost of rents and the inability of people who are paying those rents to purchase homes. And that's a very negative real impact for the overall economy.
Well, do you think that it was done to cool the housing market on purpose?
The time to have cooled the housing market on purpose and actually to have impacted the leveraged buying of homes by institutional buyers, by private equity, by your BlackRocks of the world would have been, like a year and a half ago. So yes, the net effect is to cool some of the housing prices at that level. But what's happened is, and this is why we see rent so out of whack with where home prices are and what people's affordability indices are for mortgage takeouts for new mortgages, is that it's a little bit late to kind of curtail the real swelling in home prices that happened over the last 2 years versus the actual affordability of them with respect to rates and homes. So yes, the Fed might have intended to cool the housing market, but as usual, what the Fed does tends to be blunderous and late and just sort of reckless. And in trying to quote curtail inflation for housing for your general CPI factors, which also include beyond
Mhm.
shelter and housing, things like food and gas, which they cannot control, they have created this situation, particularly in housing.
So let's talk about inflation. I was excited to have you on to get your perspective on things here because, as you know, the last numbers, there was some rejoice like, hey, okay, we actually may have a handle on inflation now. But to that point, you bring up research from analysts at Mirabaud who said even if we had 0% inflation month on month, every month, which would be incredibly dovish until the end of the year, we would still have inflation above 6% in December. The momentum may be decelerating, but 8.5 is still very high.
Well, that's right. And the momentum, yes, is decelerating, and 8.5 is high, but a lot of that inflation um, is related to things that the Fed just can't really do anything about. And that's one of the reasons why it's going to be lingering in the markets no matter what they do with rates. Because if we look at food and we look at fuel, and one thing that's interesting to note about energy prices, even if you look at inflation figures and you net out food and energy, and then you have higher inflation, but not quite obviously as high as when you include those two things, is that energy prices have impacted a multitude of things throughout the economy, which are going to be included in the overall CPI number, even if you exclude energy, such as hospital costs, such as medical costs, such as home sheltering, such as home care, such as items that require someone to transport themselves from a point to another point. So anything that requires like physical movement is also going to be inflated in its cost, in its price, because energy prices and fuel prices are inflated. So all of what's happening is that these things aren't going out of the economy anytime soon. Yes, gas prices have come down off of their highs, but we're headed into after the summer. You might have a little bit of period of a cooling off of energy prices, but then we are seeing a possibility into the winter. And Europe's actually been preparing its populations for this, for any usages of natural gas, of gasoline, of oil types of fuel are going to potentially spike up again. So whether that happens to the extent it happened when Russia invaded Ukraine at those moments, I don't know, but it could cause additional inflationary impact of fuel again. And so we might have a situation where we have this lingering inflation. The Fed can't control it, but the Fed has raised rates in such a way that it does hurt, again, other parts of the economy where the cost of money is so apparent in terms of this impact.
And just while you were speaking, made me think of your original thesis always is just follow the money, right? You're seeing the money flow into energy. I mean, what else are you seeing? What hints can this give us of what's to come?
Well, I mean, there's good and bad at this, right? I mean, one of the things that is on the positive side, in terms also of an investment standpoint and an overall trend standpoint, that is kind of related to the high inflation that we've seen, particularly in energy and food and agriculture and everything that's connected, is the new energy space. What we've just seen is a passage of the Inflation Reduction Act. Now those words don't actually mean the act will reduce inflation. I want to be very clear about that. We could even have a longer conversation about that. But what the act does have in it is that $369 billion of a combination of direct investment and also of tax incentives, tax rebates to the new energy space. That includes electrification. That includes funding of everything from nuclear to hydrogen to solar to wind. That includes more funding of large scale EVs in addition to small EVs. That includes infrastructure funding related to electrification and to batteries and to finding alternative sources of batteries, or in general, basically expanding the energy space from a technological perspective in terms of funding that and tax rebating that, but also from an upgrading and updating of a grid perspective throughout a host of different energies. That's not to say oil and gas are going away anytime soon. It's not to say coal is going away, but it's to say that there's going to be investment and a following of that money, as you just mentioned, is about following the money. It's not like the government's going to get things done tomorrow just because it passes an act. We all know that. But
Right.
it does mean Wall Street. It does mean private equity. It does mean alternative funds are putting more and more money in the sort of nascent elements of that entire energy infrastructure. And so to me, that's one of the most positive and I think long-term trends that are evolving from this particular situation that we have ourselves now. And I think it's going to be positive from an investment standpoint across the supply chain, materials to technologies to the energy usage themselves to more economic efficiency for more people. And that's global. And so I think those kinds of signs and the money that's going into those areas is something that is going to continue and that I'm actually quite excited about.
Going back to your point about raising rates and trying to curb inflation and whatnot. I mean, do you give any kudos to Fed Chair Powell on raising rates to curb inflation? I mean, what was the Fed to do here, in your opinion?
Well, so this goes back to 2008 and amplified by 2020. That's kind of why I actually call my book Permanent Distortion, because what has happened, and we do have to like kind of take a step back and consider, well, what should the Fed do in any one moment? What has it done? What was the best thing to have done? Is that all along the way, and obviously Powell wasn't there the whole time, although he was on the board for a lot of that time, he wasn't the chair, is that, we've had a situation where central banks around the world, led by the Fed, but literally all the major ones, have basically amplified their fabrication of electronic funds. And what that has done is basically allowed governments and economies to run on more and more debt, because basically they're creating money to buy that debt. So that's created a sort of artificial economy and artificially inflated markets, whether they go up or down along this way. There's still this like artificial, addition to our overall financial and economic system that really wasn't there to that extent before 2008, and it doubled in 2020. So the Fed's book grew from a $4.5 trillion high in the wake of the financial crisis, went down to 3.7 in the summer of 2019 when they pivoted back to cutting rates. And actually, unemployment figures, which they look to a lot, are sort of where they were at back then when they thought that the economy was too weak and they should pivot back from raising rates over a period of time before that to cutting them in 2019, because the Wall Street banks were getting choked in terms of their credit obligations and the money that they needed to maintain the liquidity that they wanted. So then the pandemic comes along and we get this basically doubling of the Fed's book from a creep up of 3.7 in August 2019 to 4.1 January 2020 to 9 trillion, a little bit below that now. And it wasn't just the Fed. Obviously, there's $41 trillion worth of fabricated money by central banks in the world cushioning the markets. So if you consider that as just a backdrop, is Powell right? Did he do the right thing to start raising rates this year from effectively 0% to now 2.25%, officially 2.5%? If you look at where Fed funds rates are trending in the futures markets, was that wrong or right? Well, the timing was exceptionally bad, and the Fed, and he did not learn from past mistakes that the Fed had made in the wake of the financial crisis of 2008, which is that when you create such an expansive, policy with regard to your balance sheet, with regard to QE, with regard to cutting rates back down to zero, and this is amplified around the world, and it's not like you're disconnected. You don't do that without articulating an exit plan in advance and watching it along the way. And what Powell has done wrong and what the Fed's done wrong during this entire period, and why there's such a now permanent distortion between the markets and the real economy, is to not articulate or create a more gradual exit plan along the way, when the inflation that the Fed could control, which was asset inflation, not food and fuel inflation, but asset inflation, could have been tempered. Because right now what the Fed's doing is trying to temper everything when it obviously can't.
Really well said, Nomi. So let me ask you this, about this distortion markets vis-a-vis the Fed. What do you make of the current response from the U.S. stock market, under the spotlight of higher interest rates? What's your assessment of it, and where do you think the market goes from here?
Well, what we've seen this entire year, well, actually from March, April of this year, is as soon as the Fed started raising rates and articulating it would reduce its balance sheet, though it really has only reduced it by fractions of a percent so far, and much less than what it said it would do by this point. So there is that to consider, which I do, because when I look at the H4.1 reports that the Fed puts out on a weekly basis, they're actually not keeping on track with what they said they would do to tighten or quantitatively tighten their books, which to me means someone watching the markets and participating in the markets, there's still a lot of money out there. And even if they dial down, they're not doing it to the same accelerated pace as raising rates. And there's a reason for that. It's because they own the debt. It's because Wall Street doesn't want a bunch of mortgage securities and treasury securities, and Europe doesn't want corporate securities, and Japan doesn't want equity securities like dumped into the markets to the extent that they get drawn back. So on that basis, even though we've seen a lot of volatility and markets have reacted to the tightening of money, money is still quite cheap by historical standards, and the size of this artificial kind of cushion to the markets is still quite outsized with respect to historical standards. And so you do still have this disconnect, this dislocation between the two. I think that's actually ultimately positive for the stock markets after we get through this volatile period, because the Fed, I don't believe, is going to continue this accelerated pace of rate hikes. They are going to see inflation abating a bit, even though they've had literally nothing to do with it, or very, very little to do with it. It's just kind of coincidence if that happens. If energy prices go down, obviously it's not the Fed that did it. But if that happens, and we see what we've seen is consumer confidence numbers coming down and things like that, the Fed, I think, will continue its rate hikes, but at a lower pace. So we might see a 50 basis point hike, for example, in September instead of 75. The market's going to like that as well, because you add a lower pace, of rate hikes to this cushion to historically cheap money. And I think you get, and we've seen that really, particularly since the Fed raised rates by 75 basis points, but eased off on its hawkish language in the July FOMC meeting, that the markets are responding quite sort of positively to that and looking forward. So is it going to be a smooth ride up? Absolutely not. We're going to have chop, and there's opportunities in specific names and sectors. But I think ultimately, if you look at the money that's out there and you look at the relative historical cheapness of the totality of quantitative easing and rates globally, and we've just seen China just cut its rates by a smidge, but they cut their rates. You look at this whole global picture, and I think ultimately you have to pick your spots, and you have to recognize that there's going to be volatility along the way. But I do think that the markets will react positively to this move back to sort of neutral of the Fed.
Which sectors would benefit most? If someone was honing in, which ones would you be looking at?
So again, I mentioned some of those new energy sectors, and one of the reasons for that is, and also materials, whether that's gold, silver, copper, and also the some more rare earth minerals and materials like lithium, uranium, basically the entire mineral metal space. Some of it's just kind of dawdled around like gold, and some is really just sold off, and some's been going up. But the point being that these are all related to this evolution for the most part, to real assets, to real new structures in energy, and a transition in energy. So I see all of those as having upsides. I also see some of the technology sector where they're actually building technologies for the future. So whether that's an AV, audiovisual type of technology, or what I call meta reality, so basically a combination of technology and sort of visual aids to develop, whether it's architecture or medicine or energy related technology. I think those shares have been beat up unnaturally as being caught up in the raising of the price of money over the last portion of this year. I think those have value. So that really across the energy and infrastructure sector, real materials, real metals, and real mining companies that are involved in that, real technology companies across energy and infrastructure and other areas are the places to invest right now, and basically incrementally continue to invest, because some of them are beaten up too much, and some of them have actually been holding in, and some of them have been trending up.
You mentioned gold, so it's a good place to wrap our conversation here. And we're also talking about disconnection. So help us solve this riddle, Nomi, in the context of everything that's happening in the financial landscape and the inflation we find ourselves in. A lot of gold investors, as you know, are scratching their heads, saying, "Well, why isn't gold higher?" I mean, the manipulators apparently have been caught over at J.P. Morgan. They're behind bars. I mean, everything should be perfect now for a much higher gold rally.
Yeah, so there's two main reasons that I think gold in this period has not rallied by more, and is kind of really just, like I said, dawdled around, traded off, however you look at that. There's two reasons. One is the dollar strength. So even though the Fed has been raising rates, the dollar has sort of gone in tandem, and it was basically strengthening into that period anyway. We've seen this entire dollar strengthening particularly since the wake of the pandemic. And we've seen a lot of that uncertainty in the markets continue to basically elevate the dollar. On any given day, it can sort of move back and forth, of course, but we've seen that trend up. And so the choice between that strength in the dollar right now, given uncertainty, given the rates that have been hiked by the Fed relative to some of the other major countries, we continue to see that. And that's basically put a damper on gold in dollar terms. And the other thing that I think has happened is that there has been more, this kind of relates back to energy and use materials or use metals. There's been more of an expansion from the investor base into multiple kinds of and attribute whatever definition you can to them. It can be inflation related, inflation hedging, sort of metals of the future. But however we look at it, we see more of a choice and more investing across an array of both precious and rare earth minerals and other types of metals that in the past we might not have had that same sort of diverse allocation of funds to all of those areas that can kind of they can't replace gold in terms of the past, the historical wealth preservation aspect of gold, but they can cut into the inflationary protection aspects, and they just can cut into that space of investors that are looking at more opportunities across that area. And so I think those are two reasons why gold hasn't done as well. But that's not to say that gold hasn't held in very well and also doesn't still have, which I think it has, continued upside.
Nomi, as always, thank you so much for your insights. We're looking forward to your new book, dropping October 11th, but available for pre-order now, correct?
Yes, that's correct.
Permanent Distortion, folks. Get a copy. Nomi, we love having you on. Thank you again.
Thank you so much.
And thank you all for watching. We'll have more incredible content coming your way on the Daniela Cambone Show here on Stansberry Research. Be sure to sign up at danielacambone.com so you can stay on top of all these great, insightful interviews. That's it for me. Thanks for watching.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.